Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can also follow me on Twitter and talk to me on Patreon. Nope, you read that right. You can buy Tesla shares right now and save 10% off the cost. If you're feeling remorse and regret right now that you didn't invest in Tesla earlier, even though you planned to, but you were just waiting for another dip or something like that, or didn't have the funds available at the time, but now the price of the stock has risen too much that you're kicking yourself and can't justify the outlay at today's prices, then I have a strategy that may work for you. I repeat, this is only for those of you who are not willing to buy at today's prices. You've decided the stock price is too high and you're not willing to risk the hope of Tesla riding to a $10,000 stock price. This strategy is less for investors who are still willing to buy at today's price, despite how expensive it still feels. Why? Well, obviously because there's a catch. If you're a contrarian investor though, waiting for the dip back into the what now feels low 900s, then this might be an option for you too. Or some of you might just like the idea and perhaps use this and buy some shares at today's prices. Alright, so here's the big question. How do you save 10% when buying Tesla stock? Well, when you purchase the stock, you also sell some covered calls. And I'm not talking about any covered calls, but probably more like 1 or 2 years out. Ironically, I've made plenty of videos of doing the exact opposite and buying said covered calls, which is what leaps are. But investing is not a one-size-fits-all strategy. We're all in different positions, different financial situations, and have different levels of risk we're willing to take. My videos are more about explaining all the different ways to invest in Tesla to help as many people as I can to buy as many shares in the company as possible. So what is a covered call? I explain options and leaps in details in some of my videos, and covered calls are the other side of this. Covered calls are a type of trading, and trading is something in general I do not recommend. I do not suggest you do any trading with your Tesla shares at all, but in all honesty, at times I will play with options, but only on a very relatively small scale to my actual shareholdings. It's more just for fun. I'm hearing about a lot of people right now actually who have been hit by this and panicking now, working out what to do. They sold covered calls when the stock was in the 800s or so. Sure, they sold them well out of the money, but the stock price rallied so fast, these covered calls are now in the money and have limited the amount of profit the investor would have made if they held their shares, which is why I say don't trade, just hold your shares. The market alone is unpredictable enough, but you add the complexity of Tesla into that mix too, then you have no chance. Even the options that I do play with, it's perhaps only 2 or 3 times a year, just when Tesla has gone that extreme that things don't add up, which is what I just tried to do on the recent dip because of the Evergrande issues in China. I aimed to buy an option when the stock price hit $720 with a strike price of $750. I think it only got down to $724 or so. Right now, it would be in the money about $40,000, an easy 10x return in a month or so. But hey, I can live with that, as the rest of my Tesla shares also headed to the moon. Selling a covered call is actually just a contract you're selling. You're selling it to an investor who now has the right, but not obligation, to buy your shares at an agreed upon price before an agreed upon date. The price is called a strike price. And if the stock hits that price by the time it expires, well then, your shares are gone. Even if Tesla's stock price doubled since you sold the covered call, then you likely didn't get to ride most of that profit. Firstly, one catch is, in order to do this, you need to buy at least 100 stocks, and in a denomination of 100 too, as each covered calls contract you sell is for 100 shares. If you don't have the shares to cover, then you are selling a naked call, which is highly risky and doesn't limit your exposure. So I would highly urge you to make sure you have the shares to cover the contract. I repeat, I am in no way suggesting naked calls. Yes, so this strategy starts at an entry level of over $100,000. But on the other hand, if you are spending that much on shares, then it would be nice to get a discount. What is the downside then? Well, like I was saying, you're limiting your potential gains over that time. So let's run through some examples to see if I can make things clearer. The current stock price at the time of this video is $1,115. The price has likely changed since, but this strategy is all relative anyway. I can sell a covered call with a strike price of $1,425 for just over $110 that expires in September 2022, i.e. about 10% of the current stock price. You started with $1,115, you sold a covered call and received $110 back. It has now cost you a total of $1,005 for a share. Now, doesn't that feel like a much better price to be buying it? The downside is that you've limited your capital gains to $1,425. If the stock is higher than that by September 2022, then it would get exercised and your stocks are taken from you. Although it depends on your perspective, I mean, the stock reaching 1,425 by that stage also does mean that the stocks that you were able to buy have still each increased over $300. Now that is a 30% return in under a year. That is still an outstanding return if this is the downside. Yes, 30% is good, but it's not 30%, is it? No. Why not? Well, there was also the sale of the covered call, so it was actually more like a $410 profit, which is well over 40%, which is a very impressive return for about 10 months. But if the stock ran all the way to $3,000, you essentially left another $1,500 or so on the table. Therefore, play the scenarios in your head and think about what you can handle. But remember, even if the stock price went to $1,500 and your covered call is exercised, then you are possibly still a winner. Why? Because you received that additional $110. So although you missed out on the extra $75 capital gains, i.e. $1,425 strike price, being exercised at $1,500 is a difference of $75, well, you did receive $110 for this. So there is still a positive difference of $40 there for you too. If Tesla goes in the opposite direction too, though, there is the upside. Well, what if Tesla's stock price dropped to $1,000? Well, that was all you really paid for the stock in the first place. Therefore, despite the stock dropping 10%, you're still breaking even. So this strategy does hedge you for some loss as well, which again might make you feel more comfortable investing at the current price. Bear in mind, all these numbers have been done on an individual stock calculation. Of course, remember it will need to be a minimum of 100 stocks or lots of 100. Let's review another example, as there are more expensive covered calls you can sell too, which might better reflect the risk you're willing to take. At a similar strike price of $1,400, you could even sell a June 2023 covered call for $191, taking the overall cost per stock to around $925. Wow, doesn't anything in the 900s sound cheap these days? But here you have to wait almost 2 years and hope the stock price doesn't go too high. Equally, you could push it out with a higher strike price of $2,000 and get $85 for a covered call. Remember, there would also be a lot of capital gains for your shares at $2,000 as well. And sure, it's highly possible Tesla could be over $3,000 in 2 years' time. But feel free to have a look at what covered call strategy might suit you, paired with the risk you want to take. Anyway, I don't know if this will help any of you find more conviction to buy any more shares, but I thought it was another idea that may help some of you, as I hear a lot of people complaining about the stock price getting too high, or it may work within some of your other strategies you might have, and might want to reduce some of your risk. Also, bear in mind you may be subjected to tax when selling covered calls, and you might want to factor that in also. However, I look at Tesla as buy as many shares and hold as long as possible. Some people are different and like to take profits. This might be more suitable for someone with that sort of strategy, possibly someone who does trade. Anyway, let me know if this was of any help to any of you increasing your confidence and conviction of getting more Tesla shares. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.